Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace. I'll be filling in for Stuart Weems today. What I'd like to talk to you about today are the factors to consider when setting a property budget. So, setting the right property budget for purchase, be it a home or investment property, it's a really important decision. If your budget is too conservative, you can miss out on a lot of potential capital growth, or you can risk settling for a property that doesn't meet your lifestyle needs. But on the other hand, if you overspend or overborrow, you might limit your ability to invest in other assets, or you might run into some financial strain and be drowned by mortgage repayments. So, finding the perfect balance is the key in making the wisest investment decision that you can. And look, also, you can run the risk of underutilizing the power of leverage. We've spoken about the power of leverage quite a lot. That's really a key in property investing is the leverage element. So, underutilizing that can be to your peril, but overutilizing it can also be to your peril. So, I think we can really break this question down into two questions. So, first one is how much can you borrow? And then how much should you borrow? And they're often very different things. So the first question, how much can you borrow? Well, that's your borrowing capacity. That's determined by the lenders, by the banks. Look, as a general rule of thumb, and don't take this, too literally, but we generally, if we're sort of roughly getting an idea of borrowing capacity, we work off 5 times income at the moment. Now, there's some nuance in there, absolutely. There's some type of income is shaded, whereas other income, the full amount is used. But really, look, a good mortgage broker can help you answer this question. And the borrowing capacity, it varies significantly between lenders and then also based off your individual circumstances. And so then the question, how much should you borrow? Well, this really sort of depends on your financial position, cash flow, plans, and your risk tolerance. In the past, the answer to the first question was almost always higher than the second question, as the banks used to typically lend more than what most people were comfortable borrowing. However, since credit policies have tightened a lot since 2017, it's become more common for clients to be able to prudently afford to borrow more than what the banks are willing to lend them. However, I still see a lot of people come to us and we meet a lot of people. I still see a lot of people with just far too much borrowing. And the perfect example is during COVID when interest rates really bottomed out and you could get a 2% interest rate. I've seen a lot of people that just went and leveraged up to the hills, borrowed as much as they could because serviceability was fantastic when interest rates were down at 2%. And they went and bought property and leveraged up a lot. And yeah, they would have, most of them have done quite well because there was a, good growth in property prices post COVID. But now most of them are just with interest rates up at where they are. They're coming down at the moment. But still, for the past couple of years, they've just been drowning and they haven't had any surplus cash flow. They haven't been able to do other things like make contributions to other investments or save any money. So I think there was a lot of people during that COVID period that I've seen that just leveraged too hard. And I think the point there is you've got to think about interest rates. I think just what the repayments are, the serviceability at one point in time, if they're at really bottom low interest rate levels, you've got to consider where they're going to go. And I think, people that leveraged up and pretty much put themselves to a really tight cash flow at 2% interest rates when, things during COVID when interest rates were so low, I don't think that that's wise. I think you've really got to look ahead and think about, well, no, let's assume long-term average interest rates and, conservatively go high on them. And we like to do it at about sort of 6%. I think you need to think about, well, am I going to be able to service all this debt when interest rates level out over the long term at about sort of 6%? Because you just don't want to run into the situation where you're going to then be forced to sell properties, which we have seen some people do, not our clients, but that's a really bad outcome. Being forced into selling a property, not because you choose to, but just because of the borrowing capacity and your cash flow, it's not a good outcome. Property markets go in very long growth and flat cycles, and you've got to be in it for the long term. It's okay to sell properties short term, but that you should have the choice to do that. It's never good to be backed into a corner with that decision. So the question is, how much should you borrow? So of course, it's essential not to borrow more than you can afford. So just because a bank is willing to lend you a certain amount doesn't mean it's necessarily safe to do so. I have clients that are in both sides of the equation here. I have some clients who they've got, the banks would lend the money. They've got plenty of borrowing capacity. They could go and up their borrowing, but I don't think that they should. And my advice to them is not to do it because of their personal circumstances. And then conversely, I've got some clients who are limited in their borrowing capacity, but we're really trying to maximize that because of their stage in life and where they're at. So, that some clients we're wanting them to maximize it, but they just don't have that serviceability or equity in play at the moment. So it can really differ depending on your circumstances. So to determine how much you should borrow, really the crucial number that you need to look at is your surplus cash flow. So you'll hear us talk a lot about surplus cash flow. It's another way of saying your savings, your income minus all your expenses. That's your surplus cash flow, what money you have to invest. And it's amazing how many people don't know the answer to that. I mean, it's a really critical element. Like some people have fairly good budgets, they might know their living expenses, all that sort of thing, but really the surplus cash flow is after tax, after living expenses, after mortgage repayments, after financial commitments, after school fees for kids, everything, what's the surplus cash flow left over? That's really critical. And, Stuart in his book Investopoly provides a step-by-step instruction on how to manage your surplus cash flow. And there's a link to it in this blog, which you can look at and refer to out of interest. So once you know that surplus cash flow, what you can then do is just reverse engineer the numbers to then figure out how much you can reasonably spend on a property. And so we like to work with conservative assumptions. So we think it's reasonable, once you work out what your surplus cash flow is, then look at, a gross rental yield of 2 to 3.5%. Now, this will differ depending on the type of property and the value. But then of that gross rental, we typically minus about 30% of it to allocate to expenses. So this is all expenses ranging from property manager fees, insurance rates, maintenance, land tax, the whole range of expenses. And it generally boils down to about 30%. Now, that's across the board. And some people might say that they've got much lower expenses than that, of course. It differs a lot per property. You might have a property that's part of a body corporate, so you've got body corporate fees. You might have an older property that's got higher ongoing maintenance requirements, and maintenance is factored into this ongoing expense figure as well. So it does depend on the property, but we think, conservatively across the board, it's wise to factor in about 30% being shaved off that rental income for expenses. Then the next factor, quite obviously, you've then got to minus the interest on the loan. So, as I spoke about before, I think it's wise to probably factor a long-term 6% per annum interest rate. And if borrowing the full amount, which we think is a wise thing to do for an investment property by using, a deposit loan to fund the deposit, we think you should factor in the interest at 6.5% off 108% of the property's value, just to account for acquisition costs and really the full covering of costs to acquire an investment property in that instance. So once you've worked out that budget, you've then got to add back the tax savings. So if it's an investment property, this specifically relates to, obviously the interest is tax deductible, and it is obviously going to be negatively geared in this instance by borrowing the full amount. So you've got to add back the tax savings, to be fair. So, it really depends on what tax bracket you're in. So you'd either add back 32%, 39%, or if you're in the top tax bracket, you'd add back 47%, which includes the Medicare levy. Now, it's just one point to note about the tax benefits and adding back the tax savings of the negative gearing. You don't see that up front. The cash flow immediately is without the add backs of the tax saving. You really only get the tax saving once you do your tax return, and that negative gearing is accounted for and reduces your other assessable income. However, there is an alternative. Some people do what's called a PAYG variation, which you're effectively notifying the ATO that you anticipate a loss. Therefore, they can give you what's called a PAYG variation. You can provide that to your employer, and your employer can then withhold less tax, therefore supplying you with more after-tax income on your regular pay. In lieu of the fact that you're going to be getting a big tax refund, it effectively just gives that back to you earlier. So we sometimes do that if we think it's appropriate for clients and if we want them to have more cash flow immediately after sort of buying a property that's negatively geared, just because it gives you the real snapshot, and it gives you a more realistic picture of your actual after-tax cash flow of that property on an immediate basis without having to wait. So what does this look like in terms of monthly after-tax holding costs? So using the assumptions that I've just used here, here's some examples for different property values. So if you buy a $650,000 property, the monthly after-tax holding costs are about $1,500. If it's $1 million property, it's about $2,500. $1.5 million property, it's about $3,900, and then a $2 million property is about $5,200 monthly after-tax holding cost as a rough indication. So what do you do if you're limited with your borrowing capacity and you can't quite get the borrowing for a property that you desire? Look, I think it's important to explore all possible avenues to increase your borrowing capacity if that's appropriate for you. So, getting a second or third opinion from a mortgage brokers can be valuable, as they might suggest different lenders, or they might have new ways of structuring the deal for a better outcome, or different ways of, approaching your income for the serviceability perspective. And you just need to ensure, though, when you're doing this, that you're working with a reputable professional. So, never follow advice that encourages withholding information or misleading from a lender, because ultimately you're the one signing the application and you could be held liable. And I think also you've just got to be wary not to just go with the broker who's going to give you the most borrowing capacity. It's really not always a case of who can get you the most. I think there's what you should lend, and sometimes I think there's some manufacturing of numbers to increase borrowing capacity, which you need to be wary of. So if you've explored a few different options with different professionals and you're still limited on your borrowing capacity, I think what you need to consider is just timing. You need to think, is your borrowing capacity likely to improve in the coming years? And if it is, it might just be a case of timing. You just need to wait. Borrowing capacity is made up of two key measures, so serviceability and security. Serviceability refers to your income and your expenses, while security relates to the assets that can be offered as collateral. That's often known as the deposit, or deposit or collateral against another property. So which factor is limiting you? So you need to think about that. Is it the serviceability or is it the security? If serviceability is the issue, I think you need to consider whether it will improve in the coming, 6 to 12 months, 24 months, because your income's likely to increase. You might be getting a pay rise, or, your general expenses might be reducing, something like that. So your overall serviceability might be increasing in the near future. And I think in that case, it might be better to wait. But if security is the limitation, then maybe you might have to wait as well. So it might be a case of waiting, 6 to 12 months for more comparable sales that might result in a higher property valuation to improve your capacity. It might also be that you need to put away more money into your offset account to increase the equity there. Or if you're on principal and interest repayments on your home loan, they can bring down the loan and increase the equity. So there might just be a timing factor that you need to wait in order to build up some more equity in your position. And if you don't think that the valuation that the bank provides is reasonable, you can look to go to another bank, to revalue the property if you think it's not a fair valuation and they're sort of undershooting on that value of the property. We've certainly done this with clients where we've got a valuation back and we really needed equity in the property for, a deposit loan to go for an investment property for a client. And the valuation that we got back on the home was just a little bit unders. And, in that instance, you explore around, you go to some different lenders, you get a different type of valuation. It's amazing we see how much variance there is in valuations. It's quite amazing. We see some big numbers in difference in property valuations from different valuers. So, that can be a good strategy in looking around to try and maximize that value, which will create that equity for you. Look, from personal experience, I've got one of my clients who lives in Brisbane. He's in the situation where serviceability is not a problem at all. He's got a very high income and it's been consistently high. He's self-employed, but it's been consistently high for a few years and looking to upgrade the home. But the issue for him is just equity, equity in his current property. So with him, we've done projections just to show, look, it's just a matter of time. Because serviceability is not a problem, we just need to create equity, and you're putting away this amount of money into the offset account, and also principal repayments are bringing down the loan as well. So, in this sort of 12-month, 18-month, 24-month period, this is where your equity is going to be at, and therefore this is what it will result to in the type of property that you can buy. So it's important to think ahead about that. If it's going to increase a lot, why don't limit yourself in your borrowing capacity right now? If you really want something that's going to be a 2.5 mil purchase for the next home, but you can only get sort of 1.8 or 2 mil now. But if in 12 months' time, you'll have plenty more borrowing capacity, you can borrow 2.5, or in, 2 years' time, you can borrow 3 mil. And I think it makes sense to wait, give yourself the full borrowing capacity to have a really good go at that next property and get the property that you want. So if you've explored all these options and your borrowing capacity is still tight, well, I think the question then is, should you even invest in property? If your borrowing capacity is not enough to buy an investment grade property and there's little chance that it'll improve in the next few years, then I think it might be time to consider other investment options. For example, if you can't borrow enough to buy a property, maybe a regular gearing strategy into shares could be a viable alternative, or ungeared into shares could be a viable alternative. But look, with the gearing into shares, you've got to be cautious about taking on significant gearing in the current share market, I think, especially with share indexes near all-time highs. And I think, you've also got to take caution. It's only for some people and some personalities, I think, gearing into shares. People seem to be very good and comfortable gearing into property, and they don't sort of flip on their decisions with property. They understand its long-term holds, but I've seen a lot of people gear into shares. The share market takes a bit of a dip, and the problem with the share market is you can see exactly what your share portfolio has dropped on a daily basis, which you can't with property. So as a bit of a behavioral science there, the numbers actually show that it should be quite a fine strategy, and I've done it personally myself. But yeah, I think behaviorally, because you can pull the exit, you can hit the ejector button with a share portfolio very quickly. That sort of creates some behavioral issues, in my opinion. So just got to be cautious with that, and maybe it's the idea not 100% gearing. Maybe keep the gearing rate lower, maybe a 50-60% gearing rate, something like that. So you're not seeing your share portfolio lower than your loan balance, which can be a bit of a disheartening sign. So the next question is, should you borrow to your full capacity? So let's assume you do have really good borrowing capacity and you can, invest up to $2 million into an investment property. The question we often get is, should you borrow up to this full capacity? And look, the answer, it's tough. It does depend on your personal situation and circumstances. But I mean, here's some sort of observations from our perspective. Quality over quantity. So we firmly believe that investing in the highest quality property your budget allows, it reduces the investment risk, and it's likely to deliver the best long-term returns. A high-quality asset is one that benefits from scarcity and consistently benefits from strong demand from multiple sources. And it's not just about the property being valuable, it's about being highly sought after, so fixed, and it's in limited supply, and it's got a lot of buyer demand. So, if I had a budget of $2 to $3 million, I would focus on buying one exceptional investment property rather than spreading it across multiple investment properties. And the reason being is because I've said it before, property is an unfair asset class. Typically, the higher you go up the price scale, the better chance you have of long-term above average returns and better quality. So the further you go up the price scale, the better the quality across the board. Of course, there's going to be properties out there that are $2-3 million properties that are not going to be investment grade. But across the board, the further you go up that price scale, the better it's going to be. And the reason being is because there's less competition. You're not sort of battling it out with all people trying to buy $500,000, $600,000 properties. And often they're $2 or $3 million properties for a reason, because they're exceptional properties that were probably worth $500,000 at one point, but they've experienced exceptional growth because of all these things such as scarcity and strong demand from buyers. They're close to amenities. They've got some sort of maybe character or appeal to them. They're in short supply, which drives up the price. So yeah, I mean, look, some people sort of think that buying 4 properties worth $500,000 each, and therefore having a $2 million property portfolio, is the same thing as buying one singular $2 million property. And it's really not. In my experience and our experience, it's really not. So I think sometimes people like to take a stepping stone approach. They'll go, I'll buy one 500,000, then a couple of years later I'll buy another one. And I understand diversification, of course, like that can help because you can diversify across different markets. But really buying 4 properties at $500,000 price point is just really not the same as buying one property at $2 million. So it's a big leap. Often, people have to be brave sometimes. It's often hard to go from, say it's their first investment property, to go from zero borrowing to $2 million property, But I think you've got to be brave, and that requires planning. And as long as it's thought out, you understand your budget, you're planning ahead, you know what you're going to do in terms of, paying this property down to a certain level, and you know how it's going to impact your long-term plan, then I think you should be brave. And those that do often get rewarded. So look, another thing to consider is that your home can be a good investment, of course. There's some people that aim to minimize the budget for their home to free up more funds and borrowing capacity for investment properties. However, I think that this is maybe a false economy, and sometimes it's not always quite right. Sometimes the smartest decision is to allocate a larger budget to your home to benefit from its capital growth potential. Stuart did an article, a blog and a podcast on the 14th of August 2014, last year, about live vesting, the benefits to those that invest in their home, and, all the benefits that come through home ownership. The biggest one being the main residence exemption, which is one of the biggest free kicks going around. So, I think it's important, not to be too stringent and tight on the budget that you allocate to your home just for the sake of going more investment properties. I think there's still a good viability in, going strong on the home and allocating a decent budget. Even though it's non-deductible debt, there's good benefits in investing in your home. If the equation's about generating equity, then what better way to do it through your home? Because that equity can be used as deposits for, borrowing against further investment properties. So it's not lost money at all, the equity in your home. And look, even if your plans, some people have plans to downsize. They might buy the big family home, but then think, well, once my kids have come of age and moved out, I'm not going to need to be in this big sort of 4 or 5 bedroom home, and we'd want to downsize somewhere to a bit more low maintenance. So you get great benefits out of the downsizer plan as well. There's some arrangements there where you can put money into super through doing downsizing. So it'd be freeing up a lot of equity in the event of that downsizing, all tax free, which could be really beneficial. How much you should borrow is also extremely dependent on the time horizon. So how many years or even decades away from retirement? So if you are a very long way away and you've got many years and decades before retirement, well, we think it's more appropriate to gear more and more aggressively. I'm not suggesting that you borrow more than you can afford, but we do believe that people in their 20s and 30s and 40s should avoid being too conservative with their borrowing, especially when they're a long way from retirement, because there's a long road ahead of you. And if you consider that, if rents increase, they have historically sort of in Melbourne by, assume conservatively 3 or 4% per annum, the rent will increase. You can pretty easily with a calculator sort of work out, punch it into a spreadsheet. Here's the rent at the moment on this property, but if it increases by, 3% per annum, how will the cash flow improve? Because your loan's going to stay at the same amount. Interest rates might vary, but if you're working off current interest rates, it's probably a fair assumption long term, but your rent's going to increase. So then over time, in theory, there are other property expenses that go up. Land tax, of course, that increases as the property value goes up, but naturally the cash flow should improve. And I've seen a lot of properties that people that don't have to pay down much debt at all, and the property gets itself over 30 years to roughly cash flow neutral, just because of the interest rates will sort of hover around where they are currently, but then the rent increases. And as the rent increases, then the overall cash flow and holding cost of the property improves. So the time horizon is really important. The other thing to consider is other investments. So the amount that you invest in property should be influenced by your age and other investments. So for instance, if you're young and just starting to build wealth, I don't think it's a problem if your only material investment is in property. So a massive part of your wealth is in property. However, if you're in, your 40s and 50s and you have a relatively low super balance, we'd usually recommend setting a property investment budget that allows you to still maximize super contributions whilst still investing in property. Or, if you have substantial surplus cash flow, we aim to diversify investments across various assets and ownership structures you invest in high quality property plus regular share investing in a family trust or a company perhaps, but then also maximizing super contributions. I think the analogy that I sort of have, and I once got told by my father, is that, about filling your day, the best and most efficient way to fill your day. It's this analogy, if you've heard it, about how you fill a jar. If you've got a bunch of rocks and some sand, bear with me here, the best way to fill your day is if you were to fill that in the most efficient way, that jar, you wouldn't put the sand in first and then the rocks later, because there'd still be air pockets in there. The best way is to put the rocks in and then fill the sand afterwards. So the analogy with work and efficiency is about do the big things first and then fill the gaps later with all the small bits and pieces. The same analogy applies, I think, to wealth creation. I think, you've got to naturally go and secure the big investments early. Use leveraging early. It makes more sense to do it early. You've got better, runway and borrowing capacity. Secure the big investments, but then later on into the latter years of your career before retirement, that's when you're just doing more towards the smaller things, the bits and pieces, the progressive investments like super and share investing. So I think that analogy works true, and I think it sort of plays into your age, what you really should be allocating your surplus cash flow to. And the other thing to consider as well is, look, we think if your retirement plan is dependent on selling properties pretty much immediately, once you retire, or within a few years, that's not a good thing. I don't think that that's a well diversified, thought out retirement plan if you just need to sell properties because the loan repayments and the cash flow holding cost of them, and you have no other investments, liquid investments to live off for a period of time. So I think, we like to get clients to a position where they get into retirement. Ideally, we predict they never have to sell the properties, but they're there as a backup option. But even if it's, not within a very short time period, if if it's foreseeable that you probably need to sell a property in 10, 15 years into retirement, that's okay as well. So, if you're looking to invest in property, really we think you should consider budget first and property second. So, a common mistake that we've observed over the years with people that come to us is where investors they choose a location first and then set their budget based on that. However, we believe a better approach is to set your budget first, then determine the best type of property and location for that budget. And then this ensures you're selecting the right asset that aligns with your strategy and you're not building the strategy around the assets. Your strategy should always come first before the asset. So, in our typical process with clients, when we're assessing their situation and considering whether to buy a property or not, we start by looking at the surplus cash flow, and then we look at their sort of overall long-term plan around other, headwinds that might be coming that will impact their cash flow. Then we look at, okay, well, based off your cash flow, what portion do we think we should allocate to a property? We then do the assessment of how much we think the holding cost of that property will be for them. And then that allows us then to say, okay, well, based off that holding cost that we appropriately think sits within your overall situation, that equates to comfortably going and buying a property for $1.5 million, for example. So then we start with that, the budget, then the price. And then it's not until after that that we go, okay, well, what location should we consider? We go to state, and that might depend on land tax implications, property cycles, where we're seeing those sorts of opportunities. And then it's not until that final point afterwards that we then, once we've agreed upon, okay, it's this type of property in this location, in this state, with this budget, then we, might refer to a buyer's agent to then help us with that decision. So I think a lot of people jump to going to the buyer's agent first. They think, oh, I wonder if I should buy a property. I'm going to go speak to a buyer's agent. And, is sort of the analogy is don't ask your barber if you need a haircut. If you go to a buyer's agent who specializes in purchasing properties in regional locations with an average price of 700,000, what you should do with your $2 million budget that you could purchase, well, what do you think the answer is going to be? I think it's really up to you to decide upon the budget and then the purchase price and state. And then I think that you've got to go to then a local area specialist and go to them with quite a simple and concise brief, which is, here is my budget. I'd like to purchase a property in this amount. Get me the highest quality property possible within this budget. And really, I don't think the budget setting is quite for the buyer's agent. Of course, they can give a bit of feedback. There could be some tweaking. Hey, if you go up an extra sort of 100,000 or, down 100,000 or whatnot, it can get you there's more opportunities in those. That's fine. But I think really you've got to be setting that budget and the strategy before you go to them. Okay, so I'm going to answer a few listener questions now. And the first one's come from Noriko. So Noriko has given some context around their situation. I'll sort of paraphrase it a little bit. Said that we migrated to Australia in our mid-30s. We're now 53 and 48 years old, and we've got kids that are 20, 18 and 16 years old. Our combined annual income is 155,000, and our combined super is 200,000, and our mortgage balance is 238,000. While our home's worth about 830,000. We have 11 grand in shares, 29 grand in an emergency fund, no credit card or personal loans. We love the country lifestyle. We sold our first home 7 years ago and moved to the Adelaide Hills. At this stage, we'd like to use our home equity to invest. We live in town and have a good sized shed which we could use to convert into a B&B studio. We'd like this to be a supplementary income for us. However, we'd need to invest about $150,000 to $200,000 to turn the shed into a livable space. This means this will be treated as commercial as per the local council within our residential property, which will attract higher rates and insurance costs. Our goal is to pay off our home before we retire, but if we borrow more now, chances are we may still be in debt by the time comes. Our second thought is to simply keep investing in shares regularly and let the power of compounding work instead of getting an investment loan to buy shares. Thank you very much for your reading. I hope to hear what you do. And if you have anyone in a similar situation, thanks very much. So, Noriko, I think your proximity to retirement, I don't feel as though leveraging up more is going to be a wise idea. This is my feel. And look, again, this is just information. I don't know your full circumstances, of course. This is not personal advice. But look, I think, there's still a bit in the mortgage to knock off. I think based off your income, we're still with 238,000 on the mortgage. I think you'd need to be doing a cost benefit analysis and a return on investment around doing up the shed and turning it into a B&B, bed and breakfast sort of space to lease out. So, if you go to borrow 150, 200,000, what kind of income do you, conservatively expect from it? And if you just sort of run the numbers on, well, what's going to be the interest that you're going to pay by borrowing that amount, and then what's the likely rental income that you're going to receive. If it's 15 grand a year kind of thing of rental income, it's probably going to be more than that, but whatever it is, well, then look at how long is it going to take you to recoup your investment in that initial $150,000-$200,000 outlay. And if you think it's going to be quite high, and then maybe it's worth it. But look, a high level observation is it's a risky approach. I don't think sometimes, people that have a very wealthy situation, they can take more risk, but I think when it's getting closer towards retirement, you've got that your super balance is quite low. You've still got the mortgage there. I think you sort of can't afford to make any super risky mistake, I think. So my gut feel is thinking that that's probably not the wisest idea. However, you'd know that area yourself and what kind of, income you could get and whether it'd be a really sought after leasing space for a B&B. So you'd know better than me, but I think I'd encourage you to do the cost benefit analysis and the return on investment of doing that. And you need to have a really clear plan around how you're going to repay that debt, particularly first the mortgage, which is the non-deductible. So I think you need to think carefully about that. My gut feel is probably leaning more towards you need to build up super really heavily, put a lot into super. So there's nothing wrong with paying down the mortgage and putting a lot into super. It's extremely tax effective. As long as you've got it invested right with a good super fund, it takes all the risk out of it. That does, and you can guarantee that you're going to get a good sort of outcome in doing that. So, and I don't think leveraging into shares, I don't think so. At this sort of level, I always think if you're going to do leveraging in shares and you're going to keep some debt against it, you really want to keep that so that it's cash flow neutral, the share portfolio with the gearing to under about, 30, 40, maybe 50%. So, how much gearing is that going to be based off what you can contribute to it? I think it's immaterial. I think really you should be focusing on super and paying down the mortgage. That's my gut feel, Noriko. The next question is from RC. RC says, I'm a long-time listener, really appreciate the informative content you provide. I have a question relating to a fairly recent podcast, number 326, which Stuart discussed wrap platforms for super. My question relates to, and there's a number of questions here from RC, so I might answer them as I go through them in order. My question relates to unrealized capital gains, and given I'm in my mid-30s and would be adopting a long-term investment strategy in established indexes, ETFs, for example, VDHG, this is very appealing. I note that you've mentioned swapping platforms or providers would trigger CGT. So I'm wondering what would happen if the platform, for example, NetWealth or Hub24, ceased operating. So you are correct there, RC. Swapping platforms is a change of beneficial ownership. So, the beneficial ownership is actually the trustee of the super fund. So if you have your super with NetWealth and you move from that to Hub24 or to another industry anywhere else, to any other super fund, that is a change of beneficial ownership. So unfortunately, you do have to pay capital gains tax. Capital gains tax in super is much lower, really. It's, there's 15%, but you do get the discount for investments that are held for more than 12 months. So it effectively reduces the capital gains tax to a 10% rate. But still, yes, there is capital gains tax. So that's what would happen. If I could just comment on that, what would happen if NetWealth and Hub24 were to cease operating? I don't know how worried I'd be about that. I mean, that's very, very unlikely. That would be a pretty rare event. NetWealth is, I think they've got a market cap of about $7.5 billion. They're listed on the Australian Stock Exchange. They're a massive organisation. And really, I think NetWealth and Hub24 are the two key players in the platform provider market. So, I mean, that'd have to be pretty catastrophic for that to completely collapse and you to be forced to move out. I think the more realistic outcome is that you choose to move out. Maybe one of them stops being a great service provider, or maybe you choose because you want to set up a self-managed super fund to buy property. I think there's a high likelihood that you'd choose. I don't think there's a very likelihood at all that one of these platform providers would cease. Next, moving on, would this also trigger CGT? Yes, it would. I've answered that question. To protect against this or similar, could it be advisable to invest via a very large super fund, which probably has more chance of still being operational in 25 years' time? For example, members direct option of Australian Super. Yeah, I think that's, probably has a slightly more chance, a higher chance of being in operation. But again, I don't think it's much of a risk at all, RC. I think I think it's going to be you that chooses to leave. I don't think that an organisation like Hub24 and NetWealth are going to cease operation. It's very unlikely. So, but look, yes, I think that's probably fair. The members direct one, I mean, I don't love it. You've only got limited investment options. That does allow you to accrue unrealised gains in those member direct options of Australian Super. I think Host Plus has one as well. So that does work in terms of not paying tax on an ongoing basis, capital gains tax. So yes, and that's probably safer, but then you're limiting your investment options there. You've got less flexibility, limited investment options, so you're having to trade that off as well. And then the fees, once your balance gets really, really high, once your balance gets over close to $1 million sort of thing, the industry super funds are actually less tax effective, like from a admin fees perspective, than a wrap platform, because the further your balance goes up, the more the percentage-based fees come down in a wrap platform, whereas industry super funds percentage-based administration fees are quite consistent and flat. They stay the same, those percentages. So there's that as well. So yeah, take that with what you will, but I don't think it's a huge concern. Then goes on to ask, also, could investing via an SMSF provide greater protection against incurring CGT in this investment scenario? Yes, it would. Yep, sure. I mean, no one's really ever going to force you into closing down your own self-managed super fund. You are the trustee of your super fund or the director of the corporate trustee of the super fund. So no one's that has a greater level of protection, I think. But you then go on to mention here, I understand there's pros and cons in each of these scenarios to balance, particularly the costs of operating a self-managed super fund. But I'm assuming protecting against unrealized capital gains is paramount. Look, yes, it is. But I mean, yes, you need to consider, look, I don't really think setting up a self-managed super fund makes that much sense unless you're doing alternative investments or direct property. Really, if you're setting up a self-managed super fund just to invest in ETFs, managed funds, direct stocks, term deposits, listed securities, you're going to be better off from a fees perspective on a wrap platform doing that. So yeah, there's that to consider there, RC. He then goes on to ask, another aspect to this would be what happens if the ETF I've invested in, for example, VDHG, and for those listening at home, VDHG is the Vanguard Diversified High Growth Index ETF. That's the ticker code for it. So to your question there, RC, well, what happens if that ETF ceased to operate? Well, yes, that would result in realizing capital gains as well. Yes, it would. We've seen a couple of instances of that with, smaller new ETFs where, ETF providers are trying something new. It's not sort of as much of a broad-based ETF as this, but some in the past they've ceased it and wrapped it up. If it's not getting the adequate funds that it thought it would, then they sort of cease the product. And yes, that results in capital gains when that ceases. So, yep, that's definitely something to be aware of. But look, with VDHG, that's a massive fund. So that's got $11 billion in funds. That's the fund size, funds under management. I mean, that's massive. That's a very sustainable amount there, and it's been around for a long time. So I think as long as an ETF's got really significant funds under management, it's got a good track record, historical record, I think the likelihood of that fund wrapping up is very low, RC. And the final question he has is, what happens if you have more than the transfer balance cap at retirement in terms of unrealized capital gains? So the transfer balance cap is $2 million now, or I think the 1st of July it is. So what happens if you have more than that? I won't get into the whole debate about the 3 mil super cap. Let's say you have a bit more than $2 million in there. Pretty much what you have above $2 million is just normal accumulation fund. So you can get $2 million in pension phase, in an account-based pension. And anything above that remains in a accumulation fund like you are currently in an accumulation fund. So it gets taxed at the unrealized capital gains. As I mentioned before, if it's been held for 12 months, it gets discounted to a 10% tax rate. And if it's been held for less than 12 months, there's a 15% tax rate on the capital gains if they are realized in the portion that is over $2 million of your fund. That's how it works. Okay, I've just realized I've gone very much over time here, so I better wrap it up. So until next time, bye for now.
Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.